This video is brought to you by Knowledge at the Australian School of Business. For more information, please visit knowledge.asb.unsw.edu.au.
From its origins in 1914 as a Western Australian farmers' cooperative, Wesfarmers has grown to become one of the country's largest employers and has got nearly 500,000 shareholders. Wesfarmers incorporates companies that people shop at every day. It incorporates everything from Officeworks, Target, Coles and Bunnings. Richard Goyder joined the company in 1993 and he became Wesfarmers' chief executive in 2005. He's with me now for Knowledge at the Australian School of Business to discuss how the company keeps on innovating itself and the future direction of Wesfarmers. So Richard, Wesfarmers is now a very large conglomerate. How do you keep control over what the individual parts of the company are doing?
Well, we have very good systems and processes which we've developed over time in the organisation, which means in terms of reporting we get very good reporting of how the businesses are going. In fact, we get a set of statutory accounts each month on how each business is going. So we could report monthly if we ever thought that was a good idea, which we wouldn't. So we've got good systems. We've got a very good culture in the organisation of openness. One of our core values is openness, and so I'm always confident that particularly bad news will travel to me very quickly if there's something that needs to be done. And then we have a system of divisional boards, which means that 5 or 6 times a year we're sitting down more formally with the management teams of each business going through what's going on. So I feel well informed about what's going on in the business, and I think the board does as well.
And those individual managers of those separate companies, how important is it for you to both recruit and retain the right people?
It's critical. I mean, if there's one lesson I've learned in business, it is surround yourself with good people. And so having the right people run the businesses is really important. I remember Michael Chaney saying to me one stage when I was finance director and we had an issue with one of the businesses, he said, if we think we've got to start running this business, it's time to change the manager of that business. And in a conglomerate, to us it's very important that our businesses have day-to-day decision-making autonomy, if you like, and that therefore you've got to have the right people in the businesses, and you've obviously got to be able to retain those people as well. So it's just critical.
So how do you do that? How do you retain them whilst at the same point giving them a fair amount of independence?
Well, I've always argued that running a division of Wesfarmers is as good a job as you can have, because you have all the day-to-day capacity to run the business without some of the difficulties of running a listed company, like having to deal with compliance and communicating with the market and doing those sort of things which are really time consuming. So if you're running a business in the group, Ian McLeod at Coles or John Gillam at Bunnings or whatever, you can spend your time running the business and therefore I think get good results as a consequence of that if you've getting a good team. So I actually think the jobs themselves are quite attractive, and you have to have a reward structure which makes it attractive as well, and we have, I think, a very strong culture in Wesfarmers of rewards for performance and consequences for poor performance, and so if you are doing well in Wesfarmers, then you will do well financially and your career will progress as well.
Now, you were instrumental in the takeover by Wesfarmers of Coles, $18.5 billion. Why did you look at going down the private equity route and then go down a different track?
Well, it was you've got to go back to the time. So this was early 2007. And about that time, in late 2006, early 2007, private equity was almost dominant in the capital markets. And I half expected someone to come knocking on our door at Wesfarmers, private equity, and say, we want to take over your company, because credit was unlimited, or so it seemed to private equity at the time. And so when we looked at the Coles opportunity, we thought this is something we should have a close look at. The only way we felt in early 2007 that we would get a look into Coles was if we teamed with private equity. And we thought, if we do that, we can have a share in the turnaround of the Coles supermarket business and potentially get to be the outright owner of Target and Officeworks ourselves. We thought, well, that's a pretty good outcome. And the private equity groups brought something to the equation, particularly with the likes of Archie Norman, who's subsequently become an advisor to the Wesfarmers group on it. So it was a matter of the time. And Julian, what's interesting is we were due to have bids in late June in 2007. And in the 4 or 5 days leading up to when our bid was due in, the world credit market started to tighten up a bit, which meant that for our private equity partners, the amount of debt that could be put in the transaction started to reduce, and therefore the amount of equity they needed to front up with was more. And that became a difficult issue for them literally in the days before the offer was due in. I had separately asked our people to do some more analysis and evaluation of what this would look like if Wesfarmers went alone. And not surprisingly, the results actually were quite advantageous from Wesfarmers' point of view, because you're replacing expensive different layers of debt in private equity with corporate debt at Wesfarmers. And so by the time the private equity groups effectively withdrew from the process, we were more than happy with the prospect of going it alone, particularly as we could use Wesfarmers equity as a really significant part of the consideration.
So was there a lesson that came out for you in terms of going through that at the height of the global financial crisis?
Oh, there's been a lot of lessons. I think the lessons are, when we evaluate something, we look at sensitivity analysis, and on some revenue lines you can look at plus 5%, minus 5%, because in a big revenue business that's probably enough, and then you might go extremes 10 or 20%. But the global financial crisis has shown that in some areas your sensitivities need to be plus and minus 100%, because no one forecast what was going to happen to debt markets. So for example, in hindsight, we would have run sensitivities around what happens if we can't refinance some short-term debt we've got in against this, and what do we do in that situation. So I think just the extreme volatility of the global financial crisis has been a lesson. But the other thing I'd say, and I think this is really important, is we looked at the business based on a discounted cash flow analysis. We use, as we always do in acquisitions, a conservative orientation to the way we evaluated the business. And we always assume things will go wrong. And that held us in good stead. And so it's that absolute financial discipline in good times or bad times that I think if you hold true to that, will see you through those times. And so there was this common perception after, say, 12 or 18 months after we acquired Coles, that we bought Coles at the top of the market and it was going to be an investment that didn't work. The reality is that the transaction is ahead of where we expect it to be now, and we evaluated this transaction on a margin above our weighted average cost of capital, and it'll deliver that. And I have no doubt in the long term people are going to say this was a wonderful acquisition for Wesfarmers shareholders.
And in fact, do you have the advantage of being out in Perth that you can run through those equations of working out the unknowns and just looking at it out of the spotlight? We're not right in the media bubble.
Well, we love it because you are on your own, and you're not being told constantly by people what you should do or what you shouldn't do. And so we can make our own decisions in the cold light of day, and we can evaluate things, and sure, we get experts in to come and help and look once we've done the work, but we refer to it as marching to the beat of your own drum, and in Perth you can do that. So, I think it's fine for Wesfarmers and actually great for Wesfarmers to be in Perth.
But of course, you spent all this money on taking over the company. Now you've got to turn it around, make a profit. How do you do that? How do you keep on innovating within a company? Well,
the thing around Coles was getting the right people. So there had been a failure of leadership in Coles over, I think, a long period of time, and that ultimately is a people issue. And I would say this was decades in Coles, not. I wouldn't point at any particular individual or group of individuals. I'd say there was a culture formed in Coles over probably 2 decades that needed changing. So we needed to change the people in the organisation and bring in individuals who really understand retailing. And we've done that, and we've brought in a terrific team, and Archie Norman's been outstanding for us. And so that's been a key thing. But one of the interesting things about, you talk about innovation is, we appointed Ian McLeod to the role as CEO. Before Ian came out to Coles in May 2008, he spent several months travelling around the world looking for what he thought were the best and most innovative ideas going on in global food and grocery retailing, so that he was able then to come in at Coles and look at it in the context of what's going on around the world, not just what's happening in Australia, and say, yes, the major competitor in Australia is strong and some would say dominant, but we're going to leapfrog. We're going to do this and that, innovate, and create a much better experience for shoppers, which will, ultimately create value for your shareholders.
And certainly you seem to be doing that in terms of Woolworths now. So the latest results have been pretty promising.
It is promising. Now, Woolworths is a very good company, well-run company, and has been a strong company for years. And so the last thing we're doing is getting ahead of ourselves. And what I'd say is, in fact, what will happen in all of this is I think Coles is clearly getting better. Because we're now a stronger competitor, I think Woolworths will get better. And ultimately, shoppers get a better outcome. And if you innovate, then your shareholders will get good outcomes as well, I think. So I think everyone wins in that sort of scenario.
And if you're looking at innovating, you're looking at how the market works around the world as well, how different supermarkets operate. Are you tempted as well to sort of look overseas? After all, Wesfarmers really has been very much concentrated in Australia so far.
Well, you have to be cognizant of the risks of that. And we actually are of the view that the risk for us in diversifying into a different business sector in Australia is less than diversifying into a different geography. Because if we're going to a different business sector in Australia, we understand the culture, we understand the tax system, the language, the currency, all those sort of things. So yes, we've got to get our heads around a different sector, but you can get people to help you do that, who understand a business. If you're going to a different country, then you're dealing with culture, you're dealing with exchange rates, you're dealing with government, potential political risk, a bunch of things, and then you're adding complexity to your management task as well. So sure, we'll look overseas, but we'll put a worthwhile risk premium on doing it as well, and that makes it harder because we think it is more risky.
Well, in that case, if we come back to our shores and really look at what Wesfarmers is doing here, and there really seems to be no limit at the moment to where Wesfarmers is going. Okay, retail, but things like coal mines as well, and looking at other sectors, it seems a bit surprising. Can you really see innovation there generating more profits? Oh,
definitely. One of the problems with organisations as you get bigger is you become more bureaucratic, people become more risk averse, they take less risk, and business is about taking risk. It's about not taking stupid risk, but it is about taking risk. And they innovate less and they become less creative and less entrepreneurial. And I think that's a real challenge. So one of the advantages about Wesfarmers is in aggregate we're a large company, but we are in fact many, many small companies. And one of the things we're trying to do is make sure that people in the businesses are being innovative in what they do, whether that's in our coal mines or our industrial chemical businesses or what. To me, the lifeblood of continuing to develop an organisation is innovation. And I don't think we're as good at it as I would like, but it's something we've worked really hard on.
Then what would you like, whilst at the same point remembering that, well, after all, some shareholders may be a bit wary of innovation, some of that really costly R&D that's necessary could erode the shareholder return?
Well, yeah, I want people to be thinking of new ideas and new ways, better ways of doing things. And when you think innovation, it's not just, an MP3 player or an iPad or some new invention, or it's a better way of digging coal out of the ground. It's a better way of serving customers in a supermarket or in a Bunnings warehouse or a Target. It's a safer way of running your industrial business. And so for innovation to be really successful, it's cultural, I think. And where people are thinking consistently, how can we do better than we're currently doing? And out of that you might get some good bigger ideas, but typically just lots of small ideas which all add up. And I think then also create an environment where people are engaged. And so that goes back to your people issues. If you've got an environment where people are engaged and feel they can make a really worthwhile contribution, that's going to help you enormously as well.
But how about those people on the actual shop floor, if you like, those people who are actually dealing with customers, producing widgets, for example? I mean, how do you instill in them the necessary sort of skills to be for innovation and to be entrepreneurs as well?
You want them engaged. We try and instill a sense of ownership through many of our employees having the opportunity to own Wesfarmers shares, and so we hope that gives a sense of corporate belonging. But the businesses themselves are very good at, whether it's Coles, Target, Bunnings, Kmart, Officeworks, whatever, at instilling a sense of pride and ownership in the business. And then you've got to make sure you've got the culture, whether it's on the shop floor or wherever, of asking people to be thinking and to be innovative. And I can tell you, an organisation that employs 200,000 people, it's still a scarce commodity. But it's where you see it, it's priceless.
Richard Goyder, thank you very much.
Thank you very much.
For more business news and analysis from Knowledge at the Australian School of Business, please visit knowledge.asb.unsw.edu.au.